Hello everyone, hope you're doing well. Welcome back to another video on the Road to Retiring channel. Now, if you enjoy content where I value stocks and give my estimations what the future price could be, then drop a like, subscribe to let me know that you enjoy it, and leave a comment of any other stocks that you're interested in knowing what my potential value for them could be. Now, I want to talk about Tesla today, and firstly looking at the moat, their ability to maintain growth rates in equity, EPS, operating cash flow and revenue. These are absolutely through the roof. You can see 55% compound annual growth rate for equity, 45% compound annual growth rate for revenue across this 7-year period. But for these two, for earnings and for operating cash flow, we've had to do this slightly differently because in terms of earnings, we can literally only look from 2020, as obviously we can't work out a growth rate from a negative value, and the same for operating cash flow. We can only judge this from 2018, as this was negative prior to this. But in terms of that EPS growth and operating cash flow, definitely in terms of EPS anyway, obviously these are not sustainable levels. I just thought it was worth showing, and rather than just leaving it as the hashtag num, which you see here for the total compound annual growth rate. But regardless, these growth rates are fantastic, and it's something I'm very comfortable with, their ability to maintain these. We look at how the company is investing funds, how the management is investing funds, then this becomes a bit more interesting. The return on invested capital has gradually been getting sort of better and better. You can see from 2017, this number's slightly improving every single year. And while that may not last forever, I am very comfortable at the levels now at 29.41%. So even though the average might be falling below that 10% value that I like to look for, I still think because it has consistent growth in this, I'm confident that it's going to stay above that 10% benchmark for now. I'm going to keep my margin of safety lower because of this, because I'm confident they can manage the funds effectively. At least the trend line is suggesting that this value isn't going to drop straight back down into the negatives. Now, in terms of long-term debt and their free cash flow and what sort of imminent financial trouble they're in, this picture paints a really good one, because long-term debt can be paid off by their free cash flow about 16 times within 3 years. So there's no sort of worry for imminent financial trouble based on this. But when we start to look at the value and valuations, then this becomes slightly difficult at times, because as I say, they haven't been profitable that long, and a lot of things are sort of changing and a bit of a question mark regarding them. So first off, I'll start with the things that are consistent throughout the price over earnings fair value calculation and the price over sales and price over operating cash flow ones as well. And that is a discount rate. We're going to look for that 9.5% return on our investment on top of a 10% margin of safety. And we've gone with that low 10% because their metrics are really good across the three, even though in the past they maybe have been in the negatives, but right now they're all really good, and I'm confident they're going to be able to maintain those levels. The share dilution, now I have this at 2%, but it's not the most easy thing to gather what it's going to be in the future, because you can see historically there's actually been a 5.56% increase, going from 2,490 million shares in 2018 up to 3,475 million in 2023. Now that is selling off shares at quite a scary rate, and it makes it difficult to counteract with growth. But if we look at this article here, Elon Musk has said that have his commitment, he's not going to sell any more stock until, I don't know, probably 2 years from now. Now it's not the most convincing statement, because who knows what's going to happen in that 2 years from now period. But there's also talk of a buyback, and that would make things very interesting, since the board is very open to doing a buyback, and they could pursue a share buyback between 5 to 10 billion, and they've discussed it, but they haven't signed off on it. So this share dilution, it could easily change if in 2 years time they haven't done a buyback and they want to start selling shares again. Then this share dilution could sit at 2-3%. But if they do buy back shares and they don't start selling it off again in a couple years, then it could be at -2%. And you can see how the price of earnings fair value just changed there from $172 at -2% to $155 at 0%, or even 140 at 2%. So this share dilution can have a big impact on what our fair value will be. And I want to account for the potential possibility that a buyback doesn't occur, and that in 2 years' time they actually do start selling off shares again. So I've gone for a 2% share dilution here, as I can't be super confident either way, and I'd rather account for the worst case scenario. Now, when looking at the earnings growth rate, I've actually kept it at the analyst 5-year estimate on here, and usually I like to go a bit below this because analysts typically are around 100% too ambitious. But the realistic growth rate is sitting at 22.67%. So the company definitely has the potential to maintain a 5-year compound annual growth rate of 18.5. I've left it at this rate for now. But then when trying to work out what PE multiple it's going to be trading at in 2028, this is very difficult because, as you can see, from 2020 and then through to 2012, all the time in the past, it was just trading at this PE ratio of 0.0 because it wasn't profitable. Then when it became profitable, the PE ratio obviously flew up because it was barely profitable, but it was just about. And this has slowly been coming down, and it's going to be interesting to see where it plateaus. It's currently still at a very, very high rate compared to sort of its sector. I think it's around 40. If we have a look here, it's at 46.9 in terms of the non-GAAP. The sector median sitting at 12.16 right now. But yeah, the 5-year average for Tesla is at 182. So as you can see, there's not a lot of data to go off historically for Tesla and what this PE ratio could be come 2028. But for me, I feel comfortable at a level around 28. It's a high premium, but this sort of premium can be seen on other stocks. We look at, say, Microsoft, for example. This trades around that 27, 26p level. And so I think for these really well-known companies that lots of people like, lots of people are invested in, something like Apple as well, you can see that that's around that 25 PE ratio. So I think around the 25, 28 level is where I feel a bit more comfortable with Tesla. But right now, it's trading at an expected rate of 18.5% earnings growth and a P multiple of around 38 expected in 2028. Now, I can see this potentially happening, but I'm just not super confident in it. So for myself, I think around that 25 to 28 P multiples where I'd want to be getting in. So with that would bring a 2028 value of $246. So I think at that level, I want to wait a little bit in terms of the PE ratio before buying into Tesla. If I look at price over sales, I've kept this revenue growth rate at the analyst expectation again, around 23%. You can see that's moving from 103 billion to 196, and ours is moving from 103 billion to 192. I think it's actually at 23.5, or even maybe even higher, 23.8. But there you go, that's now to that 196 billion level, but this is such a high revenue growth rate. But as it's around half of what it was in the past, it does still feel realistic at 23.8. You can see it was 45.54 historically over the last 7 years, so they are showing that it's coming down, and I think based on it coming down around half, I brought the price over sales multiple down by around half as well. If you look at the current price over sales ratio, this is sitting at around 8.13. Now it's not super consistent, as you can see, it just boomed ridiculously and then came back down, starting to move back up again now, so who knows where it's really going to land. But I think 4 feels comfortable for me at a rate where it's around half the revenue growth rate, so we'll bring the price to sales ratio relationship with that growth rate, we'll keep that at a similar level and bring that down by about half, and that would bring a fair value of $179.29 with a 2028 price of $313. That's if this 23.8 ratio does happen. If we bring that down as far as 18, then that comes way down similarly to our price over earnings fair value at the 141 value. So I'm not super confident with it because the revenue could easily fall off a tiny bit. At 18% is still a fantastic growth rate, but I'll leave it at 23% now. We'll keep it in line with what the analysts are expecting. And lastly, I want to look at the price over operating cash flow fair value. Now I've gone for 22% in terms of the growth rate. I usually like to keep this slightly above the earnings growth rate, but in line with it. So 18.5 and a 22% growth rate for operating cash flow seems reasonable. And in terms of the multiple to expect in 2028, I've gone for 24. Now this is levels we can see with companies. Apple's is around 21, 20 right now, and Microsoft's is around that sort of 20, 22 level here, 20. So these are levels that can be expected from these top companies. Right now, Tesla's is trading at 41, their price over cash flow, and their sector median's really low at around 13 and 9 in terms of the forward cash flow price. But historically, Tesla's traded at 66 for a price over cash flow over the trailing 12 months. So this could, again, there's high potential. It does remain high. It's just only potential, and I'm not confident in that ability for it to do that, but it definitely can. Because of that, I'm not confident it's going to be trading around the 32 levels. I think that's where it's trading at. If we look, that's where the fair value becomes good. If you expect the price over operating cash flow multiple to be around 33 or 32 in 2028, then this becomes a buy for you. But for me, I'm just not confident at those levels. I'd feel much more comfortable at around 24, which is similar to, as I say, Microsoft, Apple, these other premium companies that people like to own. And so based on that, that brings the price over operating cash flow fair value around that 142 mark. Based on this would bring us a 2028 price average of $266. So there's still a return there from the current price. It's not one that's absolutely terrible and is gonna fall to pieces. But for me, I'd just like to see it come down a little bit more before I buy. But it's definitely one I would like to own, just not at the current rates. If you disagree with any of this, or you think that the price over earnings, sales, or price over operating cash flow multiples will be very different to any of the sort of expectations I've said here, I'd love to hear your thoughts on it. And yeah, if you enjoyed, leave a like, subscribe, and I'll talk to you in the next one. Bye guys.